Hello everybody. So this is a video where I try to think deeply about what happened last week and how we can protect ourselves from what happened last week. This video is more for, I would say, fans of the channel, because I'm gonna get into the weeds and really talk about my thoughts here, because the speed at which this crash happened was unprecedented. This crash was deep, sure, but not the deepest. But what shocked, I think, a lot of people in tech is the speed at which this happened and how it hit all of the correlated assets together, all of the assets that the portfolio, the growth investor portfolio is supposed to have or wants to have. They were all hit together hard at once. AI, Bitcoin, energy, all sorts of proxies hit very hard at once. And so markets have changed in that the speed at which the drops happen is pretty crazy nowadays. So let me go through some formative childhood philosophy about people. So there's this famous quote. It means just because there are many people who are wrong doesn't mean they're right. Just because there are many people who are wrong, just because most people are wrong, doesn't mean they're right. It was later popularized. This quote was later popularized by Gérard Depardieu, who used to say, "Le con a raison parce qu'il est nombreux," which is to say, the fool is right because he is many, right? Because there's a lot of fools out there, and there's many more fools out there than there are people who are correct. And so, in the meantime, however a technology takes to develop, however long it takes for a company to win, the fools are going to win because the fools are most people. I know that could sound condescending. That's not the way I'm phrasing this. I don't intend this to be condescending. I'm just saying we live in a bubble, right? We live in us growth investor. We live in a bubble, and most people don't live in that bubble. Most people don't realize what's going on in the market and in the world, and most people don't realize these stocks. So the average person doesn't, and the average person freaks out, and the average person believes taglines and very, very short sentences. The average person has a very short attention span, and now the average person trades now, right? Now they have Robinhood, now they have Moomoo or whatever app they use, right? So normies think they're right because they are most of the populace, and this is very similar to first principles thinking versus thinking something because somebody else put that thought into your brain. Mostly for education, right? Often for education, they put a thought into your brain and you didn't think to reanalyze that thought on your own, right? And this is what a lot of our innovative companies do on this channel. Perfect example of that is Tesla and car paint. Why the hell do we paint cars? Do we really need to paint cars? Probably not. We probably don't need to have 5 gallons carrying 5 gallons worth of paint on every single car out there. That's first principles thinking. Most people would tell you we paint cars because that's the way we've always done it. Right? That's the way we've always done it. So this is the difference between kind of edge thinking and normie thinking, and most people are normies, and there's a lot of people, there's many more people who are wrong than there are people who are right. And of course, the stocks we bet on, we think we are right. And so if you start thinking like this is how you can look at things like popular quotes, popular sentiment, electric cars are bad, right? Very wrong. If you're a Tesla investor, if you've been following this story for a very long time, you know that electric cars are a revolution. They're 10 times cheaper. Batteries evolve very, very fast. They can back up your house. They accelerate like sports cars. They've pretty much made sports car obsolete. There are so many benefits to electric cars, but of course, the normies, I would argue still 80% of the normies don't see it. And this is true all over the world. This is true in Europe. This is true in the US, perhaps for different reasons, but most people don't see it, right? This is the same as most people thinking Chat GPT is it. But if you follow AI, if you live in this echo chamber that maybe is X, you know that ChatGPT is losing the race. I mean, they are objectively losing the race. They are nothing like Claude. They are nothing like Gemini. They have decelerated so quickly. So ChatGPT is kind of falling apart from the inside, but most normies don't do that, right? Most normies still think ChatGPT is like the state-of-the-art AI, and so easily, you can think, oh, Bitcoin is a Ponzi, and you scream Ponzi, right? Because you don't spend 10 hours reading the Bitcoin Standard, reading Saifedean, as it's frankly an introductory book. You don't even do that, right? Let alone read Human Action or over more fundamental books, more seminal books. No, you just Bitcoin Ponzi, split second, easy narrative, right? MSTR Ponzi is the same story. And of course, through history, we've had tons of examples. My favorite is, I encourage everyone to watch the movie The Current Wars, right? People wouldn't get electricity. They thought electricity was risky. They would not get electricity. They resisted electricity. Actually, you may know that factories resisted electricity. They would want to stay with steam. They were like, we're not switching to electricity. And of course, the factories that resisted electricity, they died, quite simply, because they didn't adopt electricity, because they fell for the narrative of electricity is going to kill you, electricity is risky. And you back in the 1800s, late 1800s, you had an entire campaign against electricity. Edison was very successful. They had even invented a word, electrocuted. They changed the word executed to electrocuted, right? They've created that word. It's not an execution that you go on the courthouse to see on Sunday. It's an electrocution. And think about that. It's 1900. It's 1895. Are you going to adopt electricity for your house if the term electrocution is getting adopted? Right. We're seeing the same story with self-driving today, and people like Dowd being against Elon Musk and saying that same story. You may remember this lasted a good 10 years. Buying online is risky. They're going to steal your credit card information. That is a really, really big deal. Oh, I don't trust buying online. I'm sure there are still people out there who don't trust buying online, although that is slowly going away. Back in the day, you had people who wouldn't want to get on the bridge. They wouldn't want to cross the Mississippi on a steel bridge because they did not believe it was possible to build a bridge that long. They didn't want to go in tall buildings either. They thought they would collapse. They thought bridges would collapse. They had never seen steel in this scale before, right? You had another fair period. Planes were ungodly. People didn't want to get on planes because they thought it would be a sin because you were flying too close to the heavens. So, and that's normie thinking, right? And so, of course, a lot of the thinking about our stocks is by most people is very similar to most people not wanting to switch to electricity in 1895 because electricity is risky. The market is full of people who are wrong. And so they win in the short term. They win in the short term because they are wrong. And that's why we say things like price makes the narrative. Oh, you see, I'm right. Well, I'm sorry. As long as the company is not bankrupt, you're not right? You're only right if all of the companies in the sector went out of business. Then you're right. But if not, you're not. The companies don't go. And even then, I could argue some technologies are too early. Some inventors are too early. So going back to kind of what we call irrational thinking, but really how we should think of the population. We live kind of in an echo chamber. We live in a small world. I'm always surprised on X to find so many people who think like me on X and on YouTube. And in real life, that never happens. I never meet anybody in real life who thinks like this. Never. And I'm sure it's very similar to most of you. And I would argue most growth investors are anywhere between, and of course, this is the technology adoption curve, right? This is the technological adoption curve. And this will apply to most businesses will follow that curve. And of course, by the time the laggards adopted, you have 100% market share. The new technology gets 100% market share by the time the laggards adopted the technology. So the normies, of course, come very, very late in the adoption. I would say most of the stocks we invest in, we are right here, right? If you were buying Tesla in 2020, like I was, you would be in the 2.5% of innovators. Most people didn't see it, right? Most people didn't see it, right? If you like Cathie Wood, which I've always liked, but I've always been careful with her instruments because I know she's deep at the edge. She's like super at the edge, right? But if you like Cathie Wood, you're almost very often too early. This is why on this channel, for example, I've I guess I covered a few times Rocket Lab. I had a teeny tiny position on Rocket Lab. It's pathetic how little Rocket Lab I had. I'm sad about that. But if you're looking at quantum stocks right now, you're probably so early, right? You're even earlier than the growth investor proper. Like me, as a what I call a proper growth investor, I invest companies on the cusp of them being profitable, and I want to see super high revenue growth. I want to see the revenue growth there. Right, Cathie Wood has no issue investing in pre-revenue companies. Many of you buy quantum stocks, etc. They have no issue investing in pre-revenue companies, pre-revenue quantum stocks. But that's even riskier, right? And that's risky not necessarily because you're wrong. That's risky because there's literally very little to no buyers of these stocks. And so we have to keep in mind that the normies trade too, and most people are probably either in the early majority or the late majority or laggards, right? Laggards own stocks too. Go on CNBC, open CNBC anytime. You will see like the number of people with no vision that they interview in the legacy media is astounding, absolutely astounding. And they have a lot of money. Laggards have a lot of money and they trade too. And they buy GM stock and they buy Walmart because they don't really fully trust Amazon. They don't really shop online. So they buy Walmart. Anyways, so I have a few examples of this, and this was very, very clear this week. So this is a screenshot of the damage of Thursday night damage at peak fear, and these were the 5-day moves. So this is not one day, right? This is over 5 days. So you can see Apple. So Apple is having a little bit of revival with Claude bought and a bunch of people buying Apple Minis. They got a good surprise with the iPhone. A lot of people are upgrading their iPhones right now. They've been waiting for the new iPhone, sure. But Apple is still a consumer goods company now. And I guess they have a little bit of silicon. But they've missed a lot. Apple has missed a lot. I would argue Apple has missed AI. Unfortunately, I would argue the VR headset that they did was far ahead of its time, and it didn't catch on. I thought that was a great product, but apparently it didn't catch on. So anyways, Apple is up, but the enterprises who are really, really winning today, look at NVIDIA, for example, or Google, or Amazon, they are down. They are down, right? People are rotating to Apple. Amazon stake, I'll get to that in a second, but Amazon stake, for example, I would argue it would be highly possible at one point, not too far from now, that Amazon stake in Anthropic, right? Anthropic makes Claude, that stake could be worth more than Walmart, right? But Walmart is up. Walmart is up like crazy. Amazon is down like crazy. Amazon hasn't done much in years. But a normie may not even know about Claude. They may not even know about Anthropic. They buy ChatGPT, and you see this pattern all over, right? Tesla's down, but traditional auto is up, right? You see this pattern all over. So, are we condemned to hold old world stocks to have a less volatile portfolio? That's the point of that video. I'll get to that in a second. Look at Walmart and Amazon. This is kind of unfathomable. I guess a little bit of a tangent, but to tell you how unfathomable this is, the P ratio of Walmart right now is a 46. So that means, and they have no growth. Keep in mind, Walmart has zero sales growth. Past 5 years of Walmart, zero sales growth. With a P ratio of 46, that means you're making the bet that the company is going to be around at least for another 46 years. That's a very bold bet to make. To me, that's a very, very bold bet to make. Walmart, they have a few international operations, but they're not nearly as international as Amazon. The brand, I would argue, is much weaker than Amazon. It's a weak brand. They have a human labor. They are not first in line for automation like Amazon is. And 5 years ago, I used to shop at Walmart quite often. I was actually living across a Walmart. Not anymore. Now, I mostly shop on Amazon, and I still go to the local grocery store, but it's only because there's stuff I can't get on Amazon. If I could get everything on Amazon, I would. And Amazon is slowly rolling out Amazon Fresh. Once they actually roll out Amazon Fresh, and it's effective, and it will happen, make no mistake, it will happen. There's plenty of test areas where we're already rolling it. Then I just won't go to the grocery store anymore because my fresh foods I can get on Amazon Fresh. And I never go to the grocery store anymore. So it's coming up within the next 3 years. I don't anticipate I will go buy veggies or meat at the grocery store. I don't think that's going to happen. It will just be delivered by Amazon. Retail is, by the way, finally becoming profitable for Amazon. So it's unfathomable that that Walmart is trading this expensively compared to Amazon. It's as though people buy it because it's a low beta stocks. People buy it because it's in the index. It got added to the QQQ. It's in the S&P. It's as though Walmart is trading this high because of legacy inertia or because of normie inertia. Yet if you have the strength to actually dig around the hood, you know that Anthropic's last raise was $183 billion. The value of Amazon's stake is about 61 billion. So per my calculation, Amazon owns 33.1%. 33.1% of Anthropic is what they own. If Anthropic was ever valued at $3 trillion, which could happen within the next 5 years, that would be Walmart's entire market cap. And of course, the winner of AI will be the winner of labor. Right. I mean, how many cloud agents are going to replace employees at companies? Right. This is what Jensen has been saying. He's been saying, oh yeah, I think we'll grow our number of employees. We'll be 50,000 employees at NVIDIA soon, but I think we'll have 100 million agentic AIs working for us. Who's going to operate these agentic AIs? I don't think it's going to be OpenAI. I think Anthropic is in the race. I think Gemini is in the race. I think XAI is in the race. But if you look at what happened with Claudebot, renamed OpenClaw, is taking the internet by storm, is taking the world by storm. Who's going to win agentic AI? The company who actually wins agentic AI, I think, could be multi-trillion really, really quickly. And Amazon owns 33% of it. And they power a lot of Anthropic with their Trainium chips. Is it far-fetched? I don't know. OpenAI, when OpenAI was at the peak of its hype, they were talking long-term about potentially 7 trillion. Right? And of course, Amazon has doubled its sales. Amazon is a machine, is an unstoppable machine. So are we condemned to own Walmart, to have a less volatile portfolio? What if we want to own Amazon? What if we want to own the future and not own companies who will, in my view, inevitably get disrupted? So anyways, normies. Again, let's go back on normies. So why do I say that markets have changed in this video? Well, look, volatility has always been the deal, right? We've always signed up for volatility when we buy growth stocks. Always we sign up for volatility. And we also sign up for the extent of that volatility too, right? The speed is the problem. That speed of the drop will give you some gray hair. Because if you look at Bitcoin's drop, for example, that was lightning fast speed. Caught so many off guard. Look up on X, a lot of people got entirely liquidated, right? They were like, oh, we've reached the bottom on Wednesday, not imagining much of the drop is to come on Thursday. And maybe they felt bold, maybe they went on options, maybe they went on margin, and then on Thursday, at the end of the day, you get liquidated. get liquidated in after hours. Some people got liquidated in after hours. Look up on X. It's a catastrophe. So the speed of the sell-off in tech that can happen is the danger. It's a major danger. And the markets are so much more volatile than they used to be. This is also true to what I was saying about, the decade of the 2020s. Awful decade to invest. Your only job in the 2020s is to not get wiped out. But also the speed at which we seemingly have gray to black swan events is pretty darn nuts. It's pretty darn nuts. I think we could be having events like this 2 to 3 times a year going forward. And that may be because of the speed of information. Every normie's attention span seems to have been reduced to the length of a TikTok video, or if it's not a video, a tagline. The number of comments I get from scam, Ponzi, margin call, lawsuit, dead, sell, even emojis, like they put like a dead skull emoji. It's the attention span has changed, right? I mean, I've been a growth investor my whole life. Okay, like in the early days, I remember when I was buying Bitcoin in 2015. That was a long process of learning, long process of learning. Even in 2018, when people were learning about companies like Tesla, learning about companies, not companies, but assets like crypto and Bitcoin, like amazing books were written. We had longer attention span. The average investor had longer attention span. We used to say study. But it seems like the normies have taken a different path. It seems like the normies have taken a path that looks closer to gambling. And of course, gambling has always existed in the market. But the speed at which it happens is much greater today. So are we condemned to own, quote unquote, low beta stocks to avoid such drawdowns? Should we own old world stocks? Should we own, GM and GE and stocks like that to avoid such madness? Are we forced to invest in companies that belong firmly in the past to protect the portfolio? Right? That's kind of the reason why people say you got to buy the S&P 500 because it's a lower beta than the NASDAQ. And the problem, of course, is that correlation goes to 1 in a crisis, right? Your stock, I don't know, Nebius maybe sold off. Like Nebius sold off really hard on Thursday. Why did it sell off? Because Bitcoin was selling off. And people who were owning Iron or owning anything related to Bitcoin, they were also very likely to own Nebius. So they sold off Nebius. So is there a solution to avoiding to own Walmart, avoiding to own companies like Bank of America, companies like UPS? Is there a solution to just be 100% in hypergrowth and avoid owning these non-growth companies who just happen to be green on the red days, right? How do we stay alive while being 100% in hypergrowth and avoiding to buy a purveyor of diabetes, as I like to call some of these stocks? So anyways, I found 2 potential solutions. So one of them is totally underfollowed, unknown hypergrowth stocks. Underfollowed, unknown. You should barely see them on X. And let me so out of my big spreadsheet, I have just 3 random examples I took. I mean, I just tried a few names. LifeMD barely moved, down 3%, right? Remitly barely moved, down 1.5%. Casper barely moved, 1.6%. So maybe growth stocks from, totally idiosyncratic regions of the world. Maybe that's a way to still get exposure to growth without getting all of that correlation to 1. So I think underfollowed growth stocks could be less likely to suffer from contagion. And that could be a protection to a portfolio. That could be a way, replace all of the legacy stuff. If you build a portfolio, replace all of the legacy stuff with highly underfollowed stocks who don't trade with the crowd, who do not trade with the crowd. So I think that could be a solution. Now, there's problems with these stocks, of course, is sometimes you have idiosyncratic news on these stocks and they can move really, really high. Like, for example, this is a type of stock which is more likely to move very high on earnings, for example. So there's some downside to that strategy. And then another strategy, which frankly is probably going to be the strategy I'm taking, is just adding to Strike, MicroStrategy Strike. If I look at MicroStrategy Strike, it was 3 times less volatile. 3 times less volatile during this crash. MSTR dropped 30% in 4 days. Strike only dropped 11% in 4 days. And you may say, why do I prefer Strike and not Stretch, for example? Well, because I think over the long term, the return of Strike is going to be much more similar to strategy than it is going to be similar to Stretch. Because if I look at Strike, well, first of all, before I show you kind of my work on the long-term return of Strike, just look at the short-term since Strike IPO'd. Strike is pretty much flat. Where is it? Well, it's down a little bit, right? It's down a little bit, but not really, because you got dividends. So it's down from 82 to 76, but you got the dividend, so actually you're flat. Like, your return is essentially flat. Even though the stock moved from 82 to 76, you got paid dividend 3 times, $2 each time, and so that got you back to the same level. And so that Strike barely moved. Of course, over the same period, this is end of day Friday. Same period, strategy returned minus 61%. If you were looking at Thursday, strategy would have returned minus 70%. So owning Strike may avoid you gray hair, especially if you have a portfolio like mine, where I have Tesla and I have MSTR, right? I have some of the most debated stocks out there, right? Some of the most disagreed upon stocks out there. And why would I say Strike is acceptable? Well, there's a few ways to think about it, but I'm working on the spreadsheet. I'll see if I get it completed, because I have so much work to do. But it's essentially, I'm assuming Bitcoin's going to rebound to like 90 or 100K soon. So that's why I'm using 200. It's essentially MSTR 200. In 10 years, if Bitcoin grows at 30% and we'd assume zero amplification, MSTR is essentially at a 10 or an 11x. A 10 or an 11x. Let's call it an 11x. MSTR is roughly an 11x over the next 10 years, which is really good, we may say. Well, Strike, when I start calculating Strike to me, it seems to be, and that depends on how you reinvest the capital, but it seems to me between a 6 and an 8x over 10 years. So let's call it 7x versus 11x. 7x over 10 years is an excellent return. It's more than the Nasdaq. It's more than the Nasdaq, with presumably much lower volatility. And also, with Strike, every quarter you get optionality, because of each share of Strike that you own every quarter, you get $2 per share, and you get optionality to either buy MSTR stock, if, say, MSTR stock is very down that day or seems very cheap, or you get optionality to get those $2 and spend it, or you get optionality to buy more Strike, which is really, really good. And of course, it's tax deferred. So 10 years is relevant because it's a tax deferred thing. And why is the return so high for Strike compared to any of the preferred strategy? It's because of what Saylor has referred to as a mistake, by the way. Strike was the first preferred instrument, but it's because Strike has a call option, right? Strike owns 10% of strategy. So you can see the stake, like after year 5, between year 5 and year 6, the value of the call option pays for the entire value of Strike. And once MSTR reaches $1,000, Strike is pretty much going to trade in line with strategy. So you're giving up some upside, of course, but wow, you're also giving up tremendous volatility, which could help you avoid gray hair, which could help you sleep at night better. And you get optionality too, because maybe, this is not investment advice ever on this channel, but if you saw on Thursday, strategy was down 70%, and you happen to have owned some Strike who was flat, maybe you swap. Maybe you sell Strike to buy MSTR. Maybe you do the swap. So again, to me, this is very fascinating. These instruments are probably a way to get exposure to non-disruption, super high growth with no vol and no volatility. And so maybe the perfect portfolio is a mix of mainstream hypergrowth stocks, undiscovered hypergrowth stocks, and then some strike. Maybe it's that. So I don't know. I'll be studying this more, but it's, I mean, what an humbling week. What a humbling week we've had. It's time to reflect on what happened and learned from what happened. So anyways, hopefully that was helpful. This was not investment advice. This is not financial advice. This is only entertainment. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching and have a wonderful, wonderful day.